Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Covered Calls and Short Puts. And today we're going to be using a stock that's already in our example paper money portfolio to explore three potentially very different covered call scenarios. A covered call might sound like a covered call, might sound like a covered call, but that is not the case. I think this can be an interesting discussion. I'll tell you more about it in just a moment. But before we get to any of that, let me first of all say hello to everybody who's already chatting in. Great to see all the familiar names. Hello to anybody that might be here for the very first time. But hello there. It looks like we have Olga and Mark, Scott, Jackson, Josh, Robert, Eva, everybody else. Thanks for joining us week after week. We always do appreciate your attendance, your contributions to these discussions. As I just mentioned, if you're here among those who are here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the live stream is concluded, enjoy the recording. It's a great way to watch these webcasts, but you're certainly invited to join us in the live stream. This is a Monday webcast series. We kick things off promptly at 2 Eastern time. Now, I also want to let you all know, if you're here in the live audience, my very good friend Scott Thompson is out there with you. He's going to be hanging out in the YouTube chats, keeping an eye on any questions that come in. If I can't get to those questions, Scott's going to be there to pick up slack for me. Scott and I have been working together for 2 decades now. So yeah, Scott brings a ton of experience to this. I definitely appreciate having you out there, Scott. Scott and I would also like to issue an invitation to everybody watching, whether on the live presentation or on the archive, to follow your favorite Schwab presenters on social media. You can find me on X at Cameron May CS. You can find Scott on X at Scott Thompson CS. You can also pop over to linkedin.com/in/Cameron May CS. You can find and follow me there. That's the best place to connect with me in between the live streams is on social media. But let's get into this discussion. And of course, as we do, there are certainly risks associated with what we're discussing. This is important information, so please keep it top of mind. Options carry a high level of risk and are not suitable for all investors. Schwab does not recommend the use of technical analysis as a sole means of investment research. Investing involves risks, including loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. All right. So let's set an agenda for today's discussion. The very first thing that I'm going to do, we're getting into the latter hours of trading today. So we're going to take a quick peek at what's going on with the stock market, but also what's going on in the options premium market. Then we're going to use that as a backdrop for our discussion of selling a covered call on an existing position in one's portfolio. And today I want to weigh 3 different choices, 3 very different covered call scenarios on the same stock. So yeah, we're going to be comparing an in the money and at the money and the out of the money position, choosing one of those, and then placing an example trade in our paper money account before we're done today. So a lot to cover. Let's go right into that. Let's go to the Thinkorswim desktop paper money platform. And right now we are looking at a 1-year chart of the S&P 500. And for some investors, they recognize when trading and investing in covered calls, we're actually involved in 2 very different marketplaces. We have stock ownership, and we're also in that options market. So a trader might make a habit of checking what's going on with stocks to represent the stock portion of their covered call position, but also what's happening with options to represent what's happening with the options portion of existing and potential covered call, the call portion of the position. So here's what's going on with stocks at the moment. Obviously, this is just one index. We could check a range of indexes, or maybe a trader just has a preference for a different one. Right now, the S&P is actually lining up to potentially have its highest close in history. What was the highest close was right back here on June 2nd. That was at 76.09. We're at 76.03, fraction of a percentage point. We are right there. So is this momentum likely to carry stocks to new highs and to greater heights thereafter? Or could we bump our heads against what has been a pretty prominent price ceiling for the last 2.5 or 3 months? I think that's a story that time will still tell, but it's been a nice market for the bulls, and covered calls are actually a net bullish position. So it's been a nice covered call market for a lot of people out there. But that's what's going on with stocks. At least it's what's going on with the S&P 500. Let's flash over. By the way, I saw Eva asking about a question that I made on X. Just what was that, Eva, last week? Where we were right in between 7,300 and 7,600. And I asked my followers, which one, where do we think we're going to touch first, 73 or 76? And we just got to 76. Yep. I saw you timestamp that, Eva. Got there. Okay. Well, what's going on with the options market? Let's flash over to the symbol VIX. This is the volatility chart of the S&P 500. And among other potential interpretations, by the way, I have some old drawings on here. We won't worry about those. Those were made a long time ago. Let's just clear those off. But among other potential interpretations of or implications for this chart, for some traders, they look at this to see what's going on with the general level of premiums that might be available for selling, well, also for buying, right? And on this chart, when the VIX is high, that's generally seen as options premiums are very likely high on a lot of stocks out there across a range of different strike prices. It's not going to be universally true for every stock, but generally when the VIX is high, premiums are high. Generally, when the VIX is low, premiums are low. And if we look at where we are right now, let me just draw this in for another visual reference point. Let me cancel that. Let's switch this from a text. Let's switch this from text to a trend line. Here's where we've been over the last 12 months. As far as premiums are concerned, this is just about as low as it's been. Most of the time, generally speaking, options premiums have been higher than they are right now. There have certainly been a few weeks, maybe a couple of months, where premiums have been lower, not much lower across a lot of stocks out there. So this is a possibly important backdrop for someone who's out there looking to sell covered calls. They need to be a little bit emotionally prepared that as they look across a range of different stocks, they might not be seeing the premiums that maybe were available even a week ago or a couple of months ago or several months ago. We maybe got a little bit spoiled with how high those premiums were. Now, there was a reason why those premiums were so high because the markets were really volatile. But this is where we are. So stocks, quite bullish. Premiums, down quite a bit. Now, I think I had somebody kind of chew me out in the YouTube comments, and I appreciate people following along and trying to find ways that we can improve ourselves as a community here. So I never take those YouTube comments for anything other than what they're generally intended, which is to be helpful, right? What they noted was, hey, Cameron, you didn't check the VIX. And someone else said, hey, the VIX is low. Should we even sell options when VIX is low? Well, just because the VIX is low doesn't necessarily mean that we can't sell covered calls. What it might mean is that the premiums are lower, but at the same time, that also might mean that that the markets are just being really cooperative. So yeah, we're not getting paid as much for what seems to be a lower risk environment. That can change, but that's where we kind of sit right now. But I wanted this as a backdrop because, yep, as we go look at this stock position that we have, we're going to be selling a new covered call on Alphabet because we had one and that one just expired. Bit of a spoiler. We had a contract that expired. We kept the premium in it was a fake premium in our pretend account, but hey, that's all right. But those premiums might be a little bit lower, but for some, they might still serve their purpose. In any case, let's have a look at what's going on with our other two positions first. So I do want to do a quick portfolio follow-up. We do this each week. What's going on with our Broadcom position? Well, with this, we own 100 shares, purchased at $380.37. We sold a call. This was sold on July 20th. Collected a premium of $11.95. It's pretty much in that same range right now, doing okay. But here's the history of our Broadcom position as we go to our chart. Bought those shares right here, July 20th, same time. So we did a buy right on this, bought the 100 shares, and then we sold the 21st of August, 410 calls, giving someone else the right to buy our shares from us at 410 bucks. Sold those calls for $11.95. The price of those calls has come down a little bit. If we wanted to, we could probably get out with a small profit on the call, but we're still hanging out well below that strike. There's still some time till expiration. Assignment risk is always present, but when we're out of the money, it's reduced. It can be reduced substantially, especially if we're further out of the money. So with this one, I think we're just going to leave it alone. Our shares are doing okay. Bottom here, they're worth they're worth that much. So I think, what were we up? $1,000? Yeah, $1,300 on that position. Let's just let that continue to work. Our Cardinal Health position, we bought 100 shares a long time ago. These were purchased for $155.40. Right now it's trading for $232, and we've sold a couple of premiums along the way. So here's the history of that Cardinal Health position. We bought these shares way back here, and we just kind of parked them in our paper money account and just let them ride for a while. And then right here in April, we did a very short-term covered call. We were just talking about what are the pros and the cons of selling contracts with just a week or less till expiration. So we sold a very short term. You can see that the time frame of our contracts by looking at the little line here. This was a very short-term trade. That one just expired out of the money, collected the 116 profit, and then later we sold the July 17th 230 call. That one also expired for an additional 465 profit. Now, just again on July 20th, 2 weeks ago, we sold the August 7th 240 call. So right now we have an obligation. If somebody wants to buy our shares for 240, they can do that. Those shares are not worth 240 at the moment, so it's unlikely, still possible, that they might do that. And those shares are still working their way higher. Now these contracts we sold to expire on the 7th of August, because what's happening right after that? So we didn't sell an August 21st contract, because for some traders, they prefer not to sell a covered call that carries through an earnings announcement, because it puts a cap on how much might be made if the earnings goes well, but there's still substantial downside risk if the earnings goes poorly. So it kind of creates an unbalanced reward and risk scenario there. Now, the premium might still justify it to some, but we decided to just have this contract expire before then. So there we go. That position's actually doing fine. The break even is all the way down here, mostly due to the fact that we bought it very low. The premiums have lowered our break even point by about $9.50, maybe $10. But that trade's doing fine. That premium, yeah, we sold it for 171. Looks like it's trading for about 110 right now. So we might be able to squeeze out a bit of a profit on that if we were to choose to close it out. I'm just going to let it go still. So that brings us to our Alphabet position. We own 100 shares of stock, but this webcast series is all about covered calls, not just about stock ownership. So let's go see what we've done and what we might do with Alphabet. So with Alphabet, we bought 100 shares at $349.11 right here. We then sold a call. When did we sold that right here? It was on this day. Sold the June 18th 410 call. I think we got close. The high got to 408.61. That one never really went in the money, just expired out of the money. Actually, we came all the way back down almost to our purchase price, and we've been kind of chopping around since then. So our stock has done, it was doing well, then it was not doing so well, and actually we're back on the positive side of things. So stock doing okay. Along the way, we've collected a premium of $13.40. We collected an additional premium of $3.15. We've lowered the break even down to $332.34, but this most recent contract just expired. You can see we sold that 375 call as we got to that expiration. Boy, the day before expiration, we were at 375.27. We went a little bit in the money and then fell out of the money. So finished out of the money. We need to be aware. I like to use this as a learning opportunity. When pretending to trade and then actually trading, there can be different experiences. This is a paper money account, and early assignment does not happen in the paper money account, but it certainly can happen if we're trading just American style options here. in other words, normal, let's just say the more typical options or equity options, they can be assigned early. Someone can choose to just buy the stock before expiration. That doesn't happen in paper money, but it can in real life. In any case, what this did when it expired is it freed us from that obligation, allowed us to realize the gain on that call, and now we just own shares of stock. Now let's say that we see our stock rallying nicely, coming right up to previous highs. We're kind of finding ourselves back in that 375 range again. Let me draw this in for just a moment. I'm going to draw in, how about a price level? Actually, how about back to this gap here? So I'm kind of going to be writing over some of my drawings. But let's put ourselves in the shoes of a hypothetical Google share owner. And maybe what they see is this resistance level up there at 375. That might play a role in if and where they sell a covered call. But boy, maybe this momentum is going to carry us right on through. So I want to weigh. Yeah, Mark says, yay, let's talk about in the money versus out of the money on Alphabet. That's what I want to do. Let's talk about that. So we have this stock scenario, but I want to talk through three different, very different covered call scenarios. So with it trading right at 375, what if we were to weigh, let's go in the money, look at a 365. Let's look at the money, the 375, and finally go out of the money, maybe the 385. Kind of keep the distances equal. All right, so let's come over here and we're going to do a side-by-side, break it down point by point comparison. These are just notes from another webcast. We don't care about those. Let's go to our trade tab and let's consider maybe selling a covered call here. And the first one is going to feel weird to some people. All right, but the first call that we're going to consider is to sell in the money, ITM. That's our abbreviation there. What that would be in this case would be the 21st of August 365 call. And that looks like that's trading for between 1670 and 1720. I'm going to split the difference, be a little bit generous. Let's say that we're able to sell that for 17 bucks. So that's our first example trade. Let's put in the word here, the word sell here, so that we can just sort of follow everything. But what are the pros and the cons of doing this? For a lot of people, I get this sort of immediate pushback as soon as I suggest that maybe some traders do sometimes go in the money to sell a covered call. They say, Cameron, that's wild. Why would anybody ever do that? What we're actually doing here, if we sell that call, is we're agreeing to sell the shares for less than they are currently worth. That's true. Stock right now, it's backed off a little bit, but it's worth about 374 bucks. And we're getting into a contract that says someone else can buy those shares from us for 365. That's $9 less than the shares are worth. Yes. Yeah. Some traders are totally fine doing that. But what are the pros and what are the cons of doing this? So let's look at the fun side of the equation first. One potential consideration is that this brings in, the deeper in the money we go, we get the biggest premiums. So relative to at the money or out of the money, this is always going to carry the biggest premium. Always is not a word I use lightly in these webcast series, but in the money premiums on the same option chain are bigger than at the money or out of the money. So in this case, it looks like we're getting 17 bucks per share-ish. Obviously, that's going to change. We haven't placed or filled an order yet. That's about $1,700 that might be collected. A benefit to that, a potential benefit is, okay, we have, that's a potential income, but it also can provide a partial protection if the stock goes down in price. So here's a second consideration, a second, let's say, argument for this premium. It has the greatest protection offered against a drop in the stock price. How does that work? Well, let's just talk it through this way. Let's say that we go ahead, we sell that covered call, and let's say that we do get $17, although it's looking less and less likely. The price is kind of slipping away from us a little bit. But let's say that we get that $17. So we have $17 has been paid into our portfolio, and then we just let the thing go all the way to expiration. And then we kind of come up for a breath at expiration. We look and our stock, our stock, while we've been waiting for expiration, has also fallen by $17. Well, that kind of stinks. It was worth $375 on day one. Conceptually, this would have us down at $358 on expiration day. That would be 18 days from now, or on the 21st of August. So we lost $17 on our stock, but then we reassure ourselves, oh yeah, that's right. I collected a premium of $17. That offset that loss. So it hedged or protected against that loss. Now, the hedge or protection ends at $17. That's it. But that's the size of the protection. Actually, the bigger the premium collected, the more the downside protection. Yeah. Yeah, Mark, exactly. Mark says, oh, that's an interesting phrase to you. The greatest protection, you mean as a hedge? Yeah. Covered calls are not traditionally described as a hedge. Conceptually, they provide that little bit of protection, but I want to emphasize that it's a little bit. If we sell a covered call, even this in the money covered call, where we're walking right into a contract where we're agreeing to sell the shares for less than they're currently worth, $17 on a $375 position is a pretty small hedge, right? Let's say the worst case scenario comes out, and who knows, maybe our stock just absolutely collapses. Theoretically, Alphabet could go to zero over the next 18 days. Is it likely that one of the biggest companies in the world is going to go to zero? It's going to get delisted, bankrupted? Almost no probability of that, but it's still just the tiniest little chance. So we have to acknowledge that as shareholders, our downside risk is equivalent to the value of those shares, right? So it's a $17 protection against a $375 risk. It's very partial. All right, but those are a couple of things that might draw an investor or a covered call trader to selling in the money. Now, to go along with this, though, we've got to consider the other side of the equation. That's the cons, the drawbacks. Okay, so a third potential consideration is this among the three that we're going to be weighing today has the highest assignment risk. Now, I'm almost tempted to put risk in parentheses, but I'm not going to because it's real. But our trader may actually be totally fine with being assigned. They might say to themselves, hey, you know what? The shares are worth 374, 375. If I sell them for 365, I'm taking a $9 or a $10 haircut on the shares compared to day one values. But I also got $17. So it's not like I lost money. I just didn't make, didn't make maybe as much as I possibly could have. But when a contract is in the money, that elevates the assignment risk. And especially if it's still in the money as we get to expiration, it's a near certainty. It's not a certainty. Not every single in the money contract that is assigned, but the vast majority are. So yeah, this has the highest risk of assignment. Our trader may either just be okay with that, or they might think, yeah, that's where it is right now. But if this thing pulls back a little bit, let me show you where 365 actually is on our chart. I'm going to come right here. Let's draw in a line at 365. It's right there. Is it possible that I'm going to go a little bit more. Anyway, is it possible that come August 21st, maybe our stock has come, oops, let me get rid of this horizontal line. Let's remove that drawing and replace it with our trend line tool. Could this happen? The stock comes down. We're no longer in the money, and the contract is out of the money at expiration. It just expires worthless. We just keep the $17. It applies a little bit of a Band-Aid to the loss in the unrealized loss in the shares. Yeah, that could happen. Sam's saying we're already up. How much did you say, Sam? I don't know. Yeah, we're already up about $7,000 on our Alphabet position. Maybe the trader's just okay with selling that. Now, we wouldn't realize all of that if we sold it at a lower price, But yeah, some traders may be totally fine with selling even at a lower price. All right. Now, the fourth consideration here is that this of our three potential covered call candidates is going to have the lowest maximum gain. And how about let's do this. Let's see, our stock, yeah, it's kind of fading a little bit. Let's update our price here. 365, it's probably more like 1675 that we might get on the premium right now. And I want to make a note that our stock, let's just say it's at, oh, look at that, it's 374 at the moment I went to say this. All right, let's just say that our shares are at 374 so that we can kind of use that number for the other two because it's going to fluctuate as we go. Anyway, but what is the maximum gain compared to current price right now if we collect 1675 on this premium? Well, if the stock's at 374, well, it doesn't matter where, we just need to know that we are obligated now to sell the shares at 365. Huh. 365 compared to 374 is actually a $9 loss on the stock against 1675. Let's do the math. Let's say assume the stock is at 374 at expiration. All right. So what happens at expiration? We sell the stock for 365. We lose $9 on the stock, but we make 1675 on the option. That is, how much can we make? $7.75, right? Compared to, let's say, current prices. All right, well, this is sort of laying out the pros and the cons of this covered call. And by the way, one last consideration. This is probably going to pay or play into the decision here. The preference of this trader is likely that they're okay with selling the shares, since that's actually the most probable outcome anyway. Very commonly, a covered call trader who's maybe looking to sell the shares anyway, well, instead of selling the shares right now for 374, maybe they agree to sell the shares, possibly even at a discount, but someone else is paying a larger premium than the discount that they're offering. It allows for potentially a higher net exit. You know, if the stock's at 374 at expiration, well, we sell the shares at 365, but we also get 1675. That's almost as though we exited for 381.75. Yeah. Okay, so there's your in the money contract. Let's compare that. Let's go at the money. Let's copy this. Paste this here. This is going to be our at the money trade. And our shares are still closest to 375. Looks like that's trading right around $11. So let's consider selling the 21st of August 375 call for 11 bucks. All right. Notice this premium is not as big as the other one. It's not going to be as small as our out of the money. Just as a spoiler alert, this is actually going to provide what I would call a mid-range premium. It's not the largest, it's not the smallest. Now, when we collect a smaller premium, that also is going to provide less protection. It's going to provide mid-range protection. So a little trade-off there. We get a smaller premium, less protection, but we've also reduced the likelihood of assignment. Let's look at the actual numbers here. Let's look at that 365 strike. There's actually a number right here on your screen that can give the trader an approximate probability that the contract will ultimately be assigned at expiration. What number is that? Well, actually, if we look at our delta, that can give us an approximate probability the contract is in the money and will be assigned at expiration. About 65% probability. So does that carry a high assignment risk? Yeah, right now, going in the money carries about a 64, 65% probability of assignment. What about if we sell this 375? That's actually about a 50% probability. Lower probability assignment. Now, while I'm talking about delta, probability of assignment, or the likelihood that it's going to be in the money at expiration, is one thing that this can tell us. It can also tell us how much we might make or lose in unrealized gain or loss on a $1 move on the stock. I didn't want that to be the focus for today's discussion, but I do want to acknowledge that. Sam says key here is preference. Yeah, Sam, this can play a big role, right? A trader who prefers to keep their shares might not want to be in the business of selling in the money calls, because they're actually dialing up the probability of assignment. So this one actually has a mid-range assignment risk. And in this case, right about 50%. This trade will also provide a mid-range maximum gain compared to our other two potential covered call candidates. So what's the maximum gain on this? Well, with our shares at, let's just assume 374 at expiration, our contract is at 375. Actually, let's say that the shares are called. All right. Well, I'm sorry, I'm going to have to change the assumption here a little bit, because we're going to have to assume the shares go in the money. Let's just say is in the money at expiration. Good enough. That'll work. What happens here? Well, in this case, we bought the shares for 374-ish, right? Sell the shares for 375. How much did we make? Made $1 on the stock. Hey, we didn't lose money on the stock. We made $1 on the stock. How much do we make on the option? Well, the option, we get to keep that premium, assuming that we're assigned, we keep the premium. That would be a $12 profit. So bigger profit. So you might say, well, Cameron, why would anybody do the first one if they can make a larger profit on the second one? Well, again, it may have to do with collecting that bigger premium, maybe getting that better downside protection. Maybe it's because they're convinced the stock is going to bump its head and go down, and they really value that protection. Or maybe they just wanted to sell the shares and they're just trying to squeeze a little bit more juice out of it. That's all. But what's the preference here? These traders may have no preference. They don't care if they get assigned, great. They make their money. If they don't get assigned, okay, we keep the premium, we keep the stock. Now, let's finally look at an out of the money. Let me grab all of this. I'm going to copy that. Let's give ourselves some extra space here. And let's go with an out of the money. And in this case, we're going to be looking at the 385 call. Well, as we go further up the option chain, we're requiring someone else to pay us higher and higher prices for our shares. So selling the 385 call, we're getting into a contract where we're agreeing to sell our shares not for 365, not for 375, but for 385. Someone's got to pay us a higher price. Well, they're not going to be willing to pay us as much. That looks like that's between $6.75 and $7.05. If we split the difference there, about $6.90. Now, to be fair, prices sagged a little bit, probably brought the value of these calls down a little bit. Let's say we might be able to get $7, all right, if the price rallies just a little bit. So we sell that 21st of August 385 call for $7. How does this premium compare to the other ones? This has the lowest premium. So for the trader who's in it to optimize the income potential, this may not be it. It carries the lowest premium, and as a result, if the stock collapses in price, it also offers the lowest protection. So you think, well, where's the argument for this? This is no good. Well, the trade-off here is actually down in the assignment risk and the maximum gain, the potential advantage there. This has the lowest assignment risk, if that is and maybe what I ought to do. Let's be grammatically consistent. I said greatest protection up here. What's the opposite of greatest? It's not lowest, it would be least. I'm kind of a stickler for the English language, so let's change that there. In any case, yeah, the lowest assignment risk. These shares are right now trading at 374. With someone required to pay us 385 for those shares still have some work to do. The stock needs to go up. It doesn't need to go up $1 or $2 or $3. It needs to go up like $11 before it becomes mathematically advantageous for that trader to start buying the shares at that higher price. So it comes with the lowest assignment risk. And what about the maximum gain? Well, we might get focused on this. Oh, Cameron, I only got $7 premium compared to $17 on the other one. This just isn't as good of a trade. Well, it depends on how you look at it. This actually has the highest maximum gain compared to having to buy the shares at 374 and sell them at 365 or 375. Selling those shares at 385 provides us with the greatest upside potential. That would allow us to make an $11 profit on the stock if assigned. If we buy the shares at 374, we sell for 385. It's an $11 profit on the stock. And oh, I just realized I shifted. That's terrible. Made versus make. I'm going to have to go back and fix that because that'll bother me. Anyway, assuming we're assigned, we will have made $11 on the stock, and we will have made how much on the premium? $7. I don't know. There's still future uncertainties. Let's say that we can make. I'm gonna say it that way. In any case, $18 is the maximum theoretical gain on this trade. So $18 versus 12 versus 775. There we go. So there are potential pros and cons to each one of these. Some traders will look at this and say, Cameron, you know what? I wanted to sell my shares anyway. Let me just collect a big premium. If I have to sell the shares a little bit of a discount, no skin off my back. As long as it gets called, I make my money. I keep that premium, and it's worth it to me to net out at a 775 profit. Someone else who is a little bit ambivalent about whether they keep or lose the shares, maybe they sell an at-the-money contract. And if finally, if we have a third trader whose preference is to potentially keep the shares, they want to minimize the likelihood of assignment while at least still collecting some premium, they may sell this out of the money contract. So which one do you think we should do? What do you think for this portfolio? We're already in the profit right here on the shares. We could agree to sell them at a lower price. That's going to chip away at that per share profit, but contribute a bigger premium. Should we go at the money, or should we go out of the money and see if this thing continues to run? I think for today, I'm going to go out of the money again. Let's go with this trade tab. Let's go to the trade tab. Let's sell the 385. That looks like it's going to trade right around that $7. Let's see if we can get $7 for that. We click on the ask price, on the bid price to create a sell order. And let's put this in, see if we can squeeze out $7 out of this trade as our limit order. As I click confirm and send, we're going to attempt to sell the 21st of August 385 call for $7. If we're able to collect that, we shave out the 65-cent commission. That would leave us with $699.35. And that way, if we have to sell the shares, we sell them for $385. I'm going to send that order off. Now with a limit order, there's never a guarantee that that order will fill. Oh, it looks like it did. Look at that. We wanted $7. We got $7.35. All right. So we're into a new position out through August 21st, but I did want to, before we place that trade, weigh some pros and cons of in the money versus at the money versus out of the money, because there's not a universally right or wrong answer for each income trader. So just weigh the pros and cons for yourself in your own paper money account. And there we go. All right. So guys, we've accomplished what I set out to do today. Time for me to let you go enjoy the rest of our webcast for the rest of the day. But before I do, I want to give you a quick reminder of the educational resources you have available to you from Schwab, starting with our Trader Talks channel on YouTube. If you're new to our channel, welcome. It's great to have you here. Make sure that you subscribe before you leave. There's definitely a good benefit to doing that. Pop down below the video, click on the subscribe button. It doesn't take any time to do that. It doesn't cost anything to subscribe. But here on our Trader Talks channel, this is where you can join our live streams, chat in, have your questions addressed live either by me or by Scott. You can find our playlists and play them just whenever you want to watch one of our videos. For example, if you want to see last week's webcast, you click on playlists, scroll down a little bit beyond the halfway point. It's going to be right here, covered calls and short puts. If you click on view full playlist, this will show you all the previous webcasts. I was out of the office, just taking an extra long weekend. So Barb filled in for me. But that's where you'd find those archives. Now, Scott and I would also like to suggest that you find and follow us on social media. You can follow us on X. You can follow us on LinkedIn. So you can find Scott on X at Scott Thompson CS. You can find and follow me on X at Cameron May CS. There's my handle. There's what I look like. Obviously, things have changed since this photo was taken, but I post here frequently, and if you reply to one of my posts, I just try to reply right back to you. For example, I ask my followers, hey, what lesson do you take from this graphic? It's been a great year, but boy, it really mostly just happened over the course of about a month and a half of trading right there. Anyway, so as people reply to this, I just reply right back, and that allows for interaction when the camera's not on. Now, at the same time, you can also pop over to LinkedIn. Just go to linkedin.com/in/Cameron May CS, and I post here as well. If you reply to my posts here, I just try to reply right back to you, and there's that access to your coaches in between the live streams. Scott, hey, thanks for helping out in the chats. Thanks for posting that playlist. Definitely appreciated. Thanks to everybody who's already clicked the thumbs up. I look over there and I see over 100 people watching the live stream, and we have how many have clicked that? 40. Nice. Thank you. Every time you click that like button, it's a nice little pat on your presenter, pat on the back of your presenter for a job well done. It also gives my videos a nice boost in the YouTube algorithm every time. Little click, little click. Whether you're watching live or you're on the archive, if you click that like button, it helps more people find these webcasts and learn this stuff. So definitely appreciate it. Everybody, thanks for giving me your time today. I will see you in a future webcast. I'll also look for you on X and on LinkedIn. But whenever I see you again, until that moment arrives, I wish you the very best of luck. Happy trading. Bye-bye.